Hey, welcome back everyone. Before getting into the topic of dividends today, here's a quick update of my investment portfolio as viewed through my personal capital dashboard. Personal capital is such a nifty tool and I love the different views I can choose from, which helps me understand more about how I'm allocated across my different accounts, whether that's my retirement or my taxable accounts. As mentioned in my other videos, I track my total net worth with the Mint app, and I track my investment portfolio with Personal Capital. I'm currently at about $112,900 as of today, February 22nd, 2020. We're here in the Performance tab under the Investing section, right here. So far into 2020, I am up about 3%, slightly underperforming the US stock market here. And that's mainly because as a cautious investor, I consider investable cash and bonds as important components of my portfolio. If we click here on allocations, you can still see that I'm heavy in cash, but every video I'm uploading shows that this number is shrinking as I continue to implement my plan for 2020, which is to reduce my cash by year end to a much more favorable level. The market's just quite frothy right now. Let's dig into my US stock section briefly by clicking on this kind of orange block here. You can drill into your different sections here. I have my large cap value as well as large cap blend and large cap growth. I recently sold off my small caps and mid caps and instead started a position in QQQ, which is the Nasdaq 100 index fund, which I'll discuss later on in this video. Here's a portion of the QQQ ETF that I mentioned. Specifically, what this is showing is the portion of QQQ which is allocated to large cap blend. As a cautious investor, here's another view of my asset summary as of February 22nd, 2020. All of my bond exposure is held in my 401k and Roth IRA, making my portfolio tax efficient. I'm still cash heavy, as I mentioned before, but with the coronavirus continuing to spread across the world, I suspect there will be some great buying opportunities when stocks drop for sustained periods of time. I'll be deploying portions of my $33,000 of investable cash throughout 2020. I'm continuing to reduce my investable cash position by buying full shares of VXUS and QQQ in my Vanguard taxable account. QQQ tracks the Nasdaq 100 index, which is a basket of the 104 largest, most actively traded companies listed on the Nasdaq stock exchange. About 4% of the index is exposed to international companies. The Nasdaq 100 index includes companies from various industries except for the financial industry like commercial and investment banks. These non-financial sectors include tech, consumer discretionary, healthcare biotech, industrial, and others. I already track the S&P 500 in my 401k, and there's about 34% overlap between the S&P 500 and the Nasdaq 100, which seems acceptable for now given that the Nasdaq 100 does not include financial companies and is tilted towards tech companies, which makes up 50% of the index. Beyond my heavy investable cash position, which allows me to sleep at night and gives me the option to buy the dips, I am still auto-investing across all my 4 accounts. I'm maxing my Roth IRA and maxing my 401k by year end as shown with the weekly and bi-weekly contributions. I'm still trying to find that sweet spot for my weekly taxable contributions, but at this current time I contribute $260 every Monday. Altogether, I'm paying myself first over $3,200 each month. I highly recommend investing with tax efficiency in mind, even if you're aiming to retire early like I am. After building up your emergency funds, max your retirement accounts first before contributing to taxable accounts. Let's talk about performance of dividend funds over time. It's a good thing that numbers don't lie. First disclaimer before we dig into the data. The past 11 years has been a record-breaking bull run with very little correction at all. Second disclaimer, the chart compares the fund's total returns, and the funds have different inception dates, so the funds highlighted in yellow is our focus today since they include at least one recession or crash. In general, it's always a good idea to look at data that includes past recessions or crashes because people easily forget about their tolerance for risk when prices continue to soar higher and higher, as they have done so in the last decade. Third disclaimer, the S&P 500, known as SPX, and RSP, shown right here, are the two that are not focused on dividend growth or current high dividend yield. RSP is an ETF that tracks an equal weighted S&P 500 index, and SPX, as we all know, is market cap weighted. The S&P 500 index tracks the 500 largest US growth and value companies. Some companies do not pay a dividend and some do. In fact, of the 5 most valuable companies in the world, 3 don't pay a dividend: Amazon, Google, and Facebook. Let me highlight my takeaways from the data shown. The more years of data you can observe, the more you can analyze the long-term average annual total returns of the funds. While funds like DGRW, DGRO, NOBL, SPHD, and HDV, while they may have higher since inception performance data shown in these cells in the white, and these two down here, they haven't been around for more than 10 years, shown in this column of their inception dates. You can see that in the white cells here. Like I said, they haven't been around for 10 years, so they don't include any long-term data that shows recessions or crashes. All high dividend focused funds like DVY, VYM, SDY, SPHD, and HDV, all of these guys have consistently underperformed the S&P 500 as well as dividend growth funds. You should pause the video to really see what I mean, especially in this kind of area here. Again, the high dividend yield funds have underperformed the S&P 500 as well as the dividend growth funds. The dividend growth funds include VIG, DGRW, DGRO, and NOBL. And these types of dividend growth funds produce a lower yield, and they track companies that should continue to grow their dividends. These types of funds are more tax efficient in a taxable account than the high yield dividend funds, which means there's less of a tax drag. A potential benefit of high yield dividend focused funds, like again the DVY, VYM, SDY, SPHD, and HDV, is that they tend to have a lower volatility, shown here, than other types of funds. These types of high yield dividend funds could potentially be attractive to a retiree who has built up a large principal investment amount and needs current income for higher dividend paying assets, from higher dividend paying assets, I should say. Something to note of all these different dividend funds is that dividends don't change your overall value of your portfolio, even if you reinvest the dividends. In taxable accounts, dividends are also taxed in the current year you receive them, which causes an overall drag to your portfolio after filing your taxes. As we all know, the price of the share drops by the dividend amount when it's paid to you, and if you reinvest it, all that's happening is that dividend is going back up and increasing the price of your asset. In the last 5 years, the S&P 500 has outperformed all funds in yellow, regardless if the fund's strategy is focused on dividend growth or high dividend yield. So if we look at this 12.78% in this S&P 500 cell here for 5-year performance, it's outperformed all the ones in yellow shown below. So that's VIG, it's outperformed RSP, DVY, VYM, and SDY. The S&P 500 had 12.78% for the past 5 years. And we're sticking to the yellow highlighted funds because they have a longer inception date. While RSP appears to have the highest amount of volatility, shown at 12.65%, it has produced the best total returns since inception, shown with this 11.14% out of all the other funds in yellow. Even the one down below this table, and you can see that against VDIGX. I had to be sure, and I realized there's an exception here. The exception is VDIGX, and let me show you. I performed a backtest using portfoliovisualizer.com. RSP only goes back to January 2004, but at least there's one recession or crash included in this long-term data. Portfolio 2, which is VDIGX, known as the Vanguard Dividend Growth Fund, came in first place if we look down below, with a 9.95% compounded annual growth rate for this time period with a significantly less drawdown degree. Compared to the S&P 500, VDIGX dropped 38% instead of 51%, which, when doing the math, is actually 25% reduction in drawdown, making the Vanguard Dividend Growth Fund a high-performing fund with lower volatility than the S&P 500. It is also exposed to about 10% international companies. What a tremendous fund. In conclusion, there are numerous strategies and ways to invest your capital. Do your own research and be open to learning about actual data before blindly copying others. Pave your own path. Stay tuned to see how my portfolio has held up with this past week's market correction as the coronavirus continues to spread across the world. Got questions? Feel free to comment below and or email me at themindofchase@gmail.com. Please like and subscribe for more videos. Good luck out there, everyone. Stay healthy and happy investing. Thanks a lot.